Welcome to another one of our Meet the Manager series updates, and today we're joined by Dr. Don from Plato. Welcome.
Hi, Matt.
Good to see you again.
Yes, it's good to be here.
Good to be in sunny but not so warm Canberra. Don, it's been an interesting couple of years, market-wise, domestic market-wise in particular. A couple of things we want to talk about specifically today, but how have you found the publicity around the process that you guys use in your fund over the last couple of years? Has that been a bit different with some of the political moves that have happened?
Well, certainly the ALP franking credit policy did focus a lot of attention and focused a lot of our attention as well, because clients were concerned about how it may or may not affect them. So, we have done a lot of discussions for about a year or so up until the election on how it might impact for our clients. And I think there was a lot of uninformed information about that, because there are only going to be certain types of investors that were going to be affected, which is largely self-managed super funds, but also people who own money in their own names but are low income. So there was a bit of overreaction. Having said that, those that were affected were often affected, significantly, like 20-30% of their income would actually be lost if they didn't get those franking credits.
Yeah, it was an interesting policy in that sense, in terms of you look at threshold and penalty. You're right, is that it was very potentially, even with a bit of restructuring, very small number of people who would have been affected, but they would have been quite hugely affected. But with your strategy, we might just talk briefly about what's different about your fund. And in franking credits, it's fair to say that they're an important part of what you take advantage of, but they're not necessarily the franking credits themselves aren't a driver of what you do, are they?
No, I mean, I always think of franking credits as the icing on the cake. We do, target income for clients, and in Australian equities, you get a cash dividend, and if it's got a franking credit, then that's on top of it. So, but you have to get the dividend to get the franking credit. So, to capture income, byproduct is franking. But it is quite for every 70 cents you get in a fully franked dividend, you get a 30-cent franking credit. So it's really fairly substantial.
And so does that change the companies that you tend to target with the strategy?
Well, we do have a preference for companies that pay fully franked dividends. So companies or REITs and infrastructure funds and companies that have a lot of overseas earnings won't look as attractive. But I mean, it is at the margin though. I mean, we still own CSL, which mainly it's some largely unfranked, and but it's an attractive company in total return terms. But it would be even more attractive if it paid a big fully franked dividend.
And so, I mean, that's a common difference. Well, there's a specific difference between the more common, say, income-orientated Aussie share funds in particular, that you guys are more focused on trying to find companies that are paying good cash flow, as opposed to you're trying to find ways to manipulate the amount of yield you capture. Is that fair to say?
Well, you can say that, or I like to say it is that we have two objectives. One is to we are targeting income, but we also have a dual objective, which is to beat the benchmark. And if you just focus on income, you might buy the highest yielding stocks, which are the banks and Telstra, but people can do that themselves. But that hasn't been a great strategy for the last couple of years. Telstra has cut its dividend 48%, so not only have you lost capital, but you've got half the dividend you had 2 years ago. The banks have underperformed, Royal Commission, all those sorts of things. We know the reasons. They're still paying decent yield, but I mean, if they're 20 or 30% behind the index in capital terms, you're probably not looking all that happy. I've got a 9% yield, but I've lost 20% of my capital. So I think total return is very important, and that's why we do have space to put a CSL in our portfolio, because we actively capture income and look for opportunities and buybacks and special dividends and things. But that means we don't have to have every stock being a high yield stock, and because some of the growth stocks like CSL have been pretty good. Having said that, we do have a sort of value bias, so we're not really into those high flying so-called waxes and things, which most of them don't earn much money, or in some cases no money, and don't pay any dividends. So, but their valuations to us just look extreme.
Yeah, and that's a very important point, I suppose, is that the underlying driver of your decision making is that total cash flow capture, isn't it? It's not the yield I'm expecting to get in the next quarter or 6 months or 12 months. It's that's ultimately protected by the underlying cash flow generation strength of the company itself.
Yes, and but to the extent that a company that pays a fully franked dividend has to pay tax and has to probably have the cash flow to pay the dividend, then generally speaking, that's usually a positive sign. I mean, it's not always a positive sign. Sometimes stocks can trade on very high yields and subsequently cut their dividends, and we've seen a few of those in the last year or two, the likes of New Farm and AMP. I mean, funnily enough, AMP, you could have bought it in the last quarter of last year on a 15% gross yield, which looks pretty attractive. You know, you have 15% and gross yield, including franking. But as we now know, it's cut its dividend at the start of this year, and then it cut its dividend just last week, and it's not paying any dividend for at least the short term. So, and again, its share price has been significantly challenged. In fact, one of the dead giveaways of those dividend traps is if the only reason why AMP got to a 15% yield was because its share price halved, then that's usually a bit of a giveaway that there's something wrong with that stock. I mean, the fact that it's halved in price, there's something wrong. We know what some of those causes were. But, you know, we steered clear to that one. We know some of our pure sort of income competitors who focus very much on income actually own that stock and were, you know, jumping up and down about corporate governance and other things. But, you know, we don't own it. We didn't have to worry about that.
Yeah, well, I mean, looking over the last 12 months market-wise, there's been a couple of interesting developments, and I'd say probably the December quarter is the main one. We saw a bit of a sharp drop in markets globally, not just domestically, and then a rally that sort of came into the new year. What did that period mean for you guys? Was that something that created some opportunity? Was it something that allowed you to set the portfolio in positions, or was it just sort of normal volatility business as usual for you guys?
Look, it's a bit more the latter in that we didn't really make significant changes to our portfolio. We were fully invested, so we have actually participated in the rebound. And we still like, for instance, you know, the areas that we like are like resources, particularly the iron ore stocks, which paid, Rio and BHP did big buybacks in that last quarter. Then BHP followed up with a massive special dividend in January, and then to top it off, paid its normal dividend, which was increased from last year in sort of February. So we haven't changed our view, and we think there'll be some good dividends coming out of those resource stocks in the next few months as well, because iron ore prices are pretty high. In fact, they're almost at record highs in Australian dollar terms. They're not in US dollar terms, but given where the dollar is, they're actually looking pretty good.
And that seems crazy to hear of a high yield Aussie share fund buying resource companies. It wouldn't be common.
Well, I think that's where, you know, we've done pretty well, because and our view is agnostic. It's not like we take a view and say we don't want to invest in miners. And I think that it is sort of different this time, because if you go back to previous sort of periods of strong commodity prices, the Rios and BHPs were sort of falling over themselves to spend the money. They build new mines or buy an Alcan or do those sorts of things. And this time they've shown great capital discipline, and they've said, no, we're not going to invest in new mines. We're going to give this money back to shareholders. We'll actually sell off a couple of assets and we'll pay these buybacks. And, and they're benefiting from, for us, which looks like pretty good supply and demand situation. So on the supply side, they're not rapidly increasing production. Well, they can't really, they're at full production basically. In fact, weather's probably slowed them down a touch, but they're not investing billions into new mines. They're on the supply side, they're also benefiting from some problems from their major competitor, which is Vale in Brazil, where there's been some horrendous sort of dam disasters, which have meant a couple of the big mines are closed down and largely indefinitely. I mean, the first one of those disasters was nearly 4 years ago, and that mine is still closed. It's taken a lot of capacity off, and so prices have gone up. But your flip side is, despite trade wars and everything else, actually Chinese steel production is at record highs. In fact, the trade wars is probably helping it, because what's China trying to do to stimulate its economy? Well, it's not by exports, it's by building more railways and roads and things like that, which require a lot of iron ore, a lot of steel. Just as we're seeing here in Australia, where the governments are spending a lot on infrastructure as well to prime the economy. So you've actually got a purple patch there for those resource stocks, and it could last for a couple of years. Maybe it might last longer, but we think there'll be some good dividends certainly over the next 12 months.
Well, China's a really good topic, because it's one of those ones that is almost very polarizing all the time, right? You get people of, the Chinese economy, the numbers are all fudged, it's not real, there's trade wars, there's all these issues around how China probably for the last 15 years was going to blow up and not participate. And I guess from a domestic point of view, how are you able to form a view with those sorts of global kind of macro themes, which clearly are a big driver of your decision making, whether you participate or not participate?
Yep.
What process do you guys go through to sort of separate the wheat from the chaff, if you like, and get into being able to make those sorts of calls?
Well, yeah, you do question the GDP numbers out of China because they come out very, very quickly and they don't seem to change very much, whether it's slowing or seemingly slowing or not. But, I mean, there are a couple of things that are pretty good indicators, so electricity consumption, but also steel production. I mean, that's obviously the driver for iron ore prices. And but we have a lot of focus also on iron ore prices. We monitor them every day and put them through that spot to work out what the sort of like right now, how profitable are those mines. And we're not using broker analysts or what have you. I mean, brokers actually have a centralised forecast, and most of them have got it massively wrong. Iron ore prices are over $100 US a tonne, and a lot of them are still using like $80. Some even are talking $60, whereas the current market price over $100 a tonne, something in Australian dollar terms, it's huge. We just look at what the market's telling us. The same as the dividend trap and AMP. The market's telling you, the price is telling you something. The price actually does tell you things, and but then you try and understand, well, is this just a short-term bubble or what? And that's where if you do the analysis on these dams, I mean, the issue is the first dam's closed 4 years after the event. The second accident, same sort of mine, quite likely it's going to be closed for a number of years as well. So that's huge in the supply side. And you say the thing about trade wars is China wants to keep its economy growing. That's for sure. So it'll lower interest rates or it'll pull the levers or what have you, and it's it's a fiat state sort of thing. So they actually have more control than we would have here. They don't have to tell. Trump doesn't. Has been sending the signals to try and get the Fed to do what they should do in terms of lowering interest rates, but that doesn't happen in China. They just do what they have to do.
It's an actual phone call in China. Like, this is what you're doing. Yeah.
That's right. So, but you got to keep vigilant all the time. And I mean, the issue for us is we are active. So I mean, if things change and they can change pretty quickly, we would reduce our exposure to iron ore pretty quickly if we saw the prices coming back or things changing.
Yeah, so that's an important part of it, I suppose. So you have these sort of, to continue with the analogy, the canaries in the coal mine, if you like, that you have these flags as part of your process to say, how do you decide that the position you took is either now wrong, you got it wrong, was right but it's run its course? What sort of things do you guys have in place to tell you when it's time to start changing a position?
Well, the first one is valuation. So, and again, that's price is an important thing. If the price doubles or triples and the earnings don't, then things are going to look a lot more expensive. So, we monitor value every day. We monitor prices every day and compare them to things like earnings or dividend yield, etc. And that's an important part of the process. But then we also monitor, the direction of earnings. And so for resources companies, it's actually getting better and better because, iron ore prices are going up. But if that trend changes very quickly and then you start to see them, deteriorating, then that's another signal that we look at. So, you'll look at the direction of earnings, the valuations, and things that are the less likely to change so that they don't change as rapidly is like quality of companies. So, but they can change. I mean, AMP gets a new CEO, he's highly regarded, etc., and so that can change that sort of thing. But I mean, the problem with it, I use AMP as that sort of thing. We don't see any real signs that the earnings are improving. We don't actually think it's all that cheap, and we haven't owned it for quite a while, and right now we have no likelihood of buying it in the near future.
So that's a really good example. So how do you? Would it be fair to say that you don't go into those sort of turnaround opportunities as a general rule then because of that, because you want that stability? Or have there been times recently or in the past where an AMP type opportunity, a stock's been hammered for what seem relatively obvious reasons and reasonably potentially structural as well. Is it for you guys, is it a case of there's just better lunch elsewhere and you stay away from it, or is there certain triggers that would tell you that the rebound is going to come in a time frame that's acceptable and therefore it's an opportunity for you?
So I think, well, we would, people that get in very early are contrarian value, and we're not contrarian. Value is part of our process, but we're not going to go in and try and buy something at the very bottom. It's a bit like catching a falling knife. We want to wait. It might look cheap, and I still don't think it looks cheap because the earnings don't look great, right? So I mean, you always got to compare value to earnings, and if the earnings aren't behaving, then may not. Then it's going to be difficult to find that value. So what we want to see is some sort of turnaround. So some clear signs that it's turning around. We're not going to try and preempt that. So. So we might leave some of those early opportunities on the table, but often they're risky because they can still go both ways. You can buy something that's cheap, and a year later it might be out of business if there's structural change and those sorts of things.
And so is that part of the discipline that because you're very much a yield focused fund, not just in the sense you're trying to generate, but you're trying to pay it out on a nice regular basis as well, right? So trying to make sure that you don't go into things that may have great upside but could hurt you in that cash flow. Is that part of the reason you don't?
Yeah, we see ourselves as, part of the, focus is on income, but also total return. So, but also capital preservation we think is pretty important, particularly for retirees. If you're investing, if you're retired and, you have this nest egg, you want it to last. And so, we're not going to take huge risks, trying to get that 10 bagger, buy the stock that at 10 cents that goes to $1. Because if it's worth zero, we're not going to look great. So we actually go the other way. We actually try and predict stocks that might be what we call dividend traps. Say AMP's been a classic example of that. New Farm probably is. There's been a few others in the last 12 months. So we try and deliberately avoid them because they may actually look great because they might be trading on a pretty good yield, but it's usually because the share price has fallen. We track a number of issues there. Again, profitability and earnings are quite good. Payout ratios. So, if they've been paying out more than 100% of their profits or close to 100%, then it's unsustainable. Might laugh, but there are companies.
No, it happens all the time.
Yeah. And we want to avoid those because when they do come out and say, well, sorry, we're not going to pay any dividend, which AMP did 2 weeks ago, then they're down another 10%. And that stock's already more than half what it was. Had already fallen more than 50%. Comes out, cuts its dividend, and it's down another 10 or 20%, and that's not great for shareholders. So we do our best to try and avoid those, but clearly we do like stocks that pay above average income. But you want to be aware. I think the first lesson of income investing is don't just buy the biggest, juiciest historical yield because often it's a sign that it's unsustainable.
Yeah, and that first and foremost is what we like about your process is about you're trying to buy sustainable income and maximise the sustainable income. So is there an example of where, either recently or, a favourite story you like to tell around where you've got that particularly right or wrong?
We haven't got too many negative stories actually in the last 12 months called it pretty right. But the resource story has been a great one because we've been talking about this for like 12 months, 18 months, and it just gets better. And whereas I think a lot of managers have not, and the average active managers struggled in the last sort of 12 months, but because I think they do have a bias against resources and they have, disappointed in the past, but it just seems to me we have new management. They're focused on capital management and returning income to shareholders, but their earnings are getting better as well, and so they're actually got some structural change to be better capital management, but they're also significantly benefiting from the cycle.
Yeah, but I think, so you're right, the resource is one of those very polarising, especially in Australia because they're a dominant part of the index, but then the variability is quite high, and that's obviously driven by volumes and pricing, and especially, back in the good old days when spot pricing wasn't such a big part of the variability in their earnings, as it is, particularly as it is now, then it was much easier to be a bit more predictive, I suppose, in terms of potential. But I guess because China's been such a big part of that and driver of the Chinese story falls over or tails in, then that's going to have a big impact on prices. And that to me, that risk has almost been overplayed to some degree. And I take your point around the whole supply side constraint around, if especially a major part of the sea going, ore is just not going to be there now. It's not they've had a bit of an issue and they've cut production, or it's like OPEC and they're playing around with the numbers. It's like the mine's not operating. You're not going to get the stuff out. You now need a huge drop-off in demand, which never responds. People don't stop consuming something because they think in another year or two there's going to be less of it. So I think that's been a big reason why people don't play in that space. And the reason I ask that question is because I think it's always interesting to hear how previous mistakes, if you like, burn people's decision making going forward. We had a disaster in resources back in 2000 and blah, and we just don't do resources anymore. Is to be fair, a more not as direct a comment that I hear, but that's the underlying reason why I think a lot of active managers just go, I got burnt and I don't know how to do it, I won't go back there.
Yeah, I think you're right there. I mean, and it's not just resources, it's other stocks. I
sure.
mean, the story, this is long ago, but it was a stock that had, I think the analysts reckoned they lied, and there were all sorts of issues or corporate governance issues and everything else. And the analyst and we actually lost this is my previous employer. Yeah, this stock fell about 50%, and it's just like we're never going to buy that stock again. Well, 2 years later, there's a bit of a turnaround, change of management, and the stock's up 100, 150, 200%. And the analyst suddenly, is very slow to actually realise that, get that negative view out. And I think that's one of the problems. And we're not necessarily 100% wedded to resources. We could get it wrong, and that's why we always have our checks and balances. Is you always come back to what is the spot price today. We're monitoring how much their production is across all. Iron ore's easy, but if you look at the BHP or Rio, they've also got a lot of copper and aluminium and all sorts of things. We track that, the whole basket of their commodities every day, and you can't fight if that trend turns down or what have you. It's not like we're wedded to this view. The resources are different this time. So, but it also means you can get that opportunity, because 3 years ago actually we were quite negative on resources, and they had big cuts in dividends and those sorts of things. So we try and be agnostic to that rather than say I'm never going to buy this or never going to sell that, or we've held Macquarie for a number of years, but next year can be completely different. So if it doesn't stack up on earnings or value, if it's expensive and the earnings aren't there, then we should be underweight.
All right, look, that's been insightful as always. Is there a single or maybe a couple of tips if you were saying to investors, what's the lesson that you think every investor should know that they don't actually know?
They don't actually know. Well, one of the things that I think that maybe they should know it, but there's a theory about overconfidence that the average investor is too confident in their ability to pick stocks and or make decisions full stop. I mean, I think if you survey most people, and the same with a lot of things, driving or what have you, you say, who here thinks they're above average driver, and probably 90% of the people will put their hand
Certainly
up.
men anyway.
Yeah, men
something
in particular.
Like 90% of men think they're above average. Yeah.
In fact, there is a bias that men actually suffer from this more than women. So overconfidence is one of the things. So you get stuck in your view, and it's often hard to do that. And it's hard not to do that, because what you do is you have a strong view on something, and you'll focus on all the factors that seem to be consistent with you, and you'll probably tend to sort of disregard the ones that don't satisfy your view, and so that makes you even more confident because you're not actually looking at things. And what we try and do by having a lot of indicators that are pretty much like we grab the data, we could grab the commodity prices. That's a fact, and you can't avoid that. So. These things are basically, a lot of these are automated. So every day we grab these prices, we collect the production every year, grab the prices every day. It's there in front of you. You can't change the numbers. Whereas if you're just reading things, it's very easy to go, this is a positive story. This supports my view on whatever it is.
Confirmation bias, right?
Yeah, bias. And it's difficult for humans to overcome that bias, I think. And that's, so I think people should try and think, well, why am I wrong rather than why am I right? Or why could I be wrong? Because, I heard a sad story actually the other day, which is I did a presentation at the ASX, and an investor got up there and said, I got AMP given to me in the float. have I got any
It's
hope?
never a good start, right?
Yeah, and you know, it's a tough thing. I mean, and all I could say was, I can't give him advice or anything else. My only advice was, well, at the moment, it's at the bottom. It's basically ranks at the bottom of our financials. We don't own it. Say that we have no clear sight, but you know, it could be a great turnaround stock and management.
Look, absolutely, you could be wrong, right?
But in our, I mean, this is where I think we are different in that we don't. I'm not going to say to you, we're going to hold these resource stocks for 5 years or 3 years. I could come back here next month and tell you something different because, you know, things might change. I mean, you look at the last 12 months, there's been a massive change in markets, or two massive changes. But if you, a year ago, and certainly even the December quarter last year, everybody was worried about rising interest rates. That's one of the main reasons why the market fell. It was a slowing economy, trade wars, and rising interest rates. Here we are, market's 20% higher than it was in December. We're still worried about trade wars. We're still worried about slowing economies, but we're not worried about interest rates rising. We're actually almost worried about interest rates falling, and they've fallen 0.5% here in Australia to a historic low of 1%. Some people are saying it might go another 0.5% lower. But that discount rate change, to me, is the main reason why the market's rallied 20%, because if you value things at a much lower interest rate, when you put them through model, it's just mathematics, lower interest rates should translate into higher prices. Because it's certainly not driven, the market rise hasn't been driven by earnings increases. To me, it's all about the discount rate, all about people realising that rates are going to be lower for longer and potentially much lower than we thought, because most of us, including myself, thought we were stuck at 1.5%. Now, it could be 0.5%.
Well, yeah, I think globally the expectation of the US were leading that, I suppose, that there's an expectation of a rising back to a more normal level, whatever that is these days. But you're right, that's a very important structural change in terms of what's an appropriate valuation. I really want to thank you for your time. I really love the answer you gave around confirmation bias, because it's a big thing that we try and get people to understand, and the fact that you guys recognise it so thoroughly that you know you can't trust yourselves either.
Yeah.
Because you're just human at the end of the day, and that you have, and that to me, that's what data's for. And seeing people make mistakes with data is they try and use the data to tell them what to do, and data's terrible at that. That's the analysis of the data tells you what to do. And people make the mistake of, because data's failed them in the past, then they start to ignore it, and they just got to more go on their intuition. And data's really, really good at telling you you've got decisions to make, but then you've got to rely on, other things to make those decisions. And that's clearly why you guys have been doing this so well for so long. So thanks for coming in. I look forward to catching up with you again next time.
All right.
Thank you.